Okay, we're here with the Adam Snabel mortgage team. We've been doing a whole series on multiple topics just related to the mortgage process, what goes into buying a home, and how you should look for a good team, specifically for your loan. So we've talked about all kinds of things. If you haven't looked at the other videos and kind of checked out the whole conversation, please do, because it's very helpful information. For this conversation, we want to talk about competitive markets. And we want to talk about all the ins and outs of how you guys are helping people win when it comes to a high competition. So let's kind of start with maybe give us a quick summary of what this can look like. What is a competitive market?
So we have a lot of experience in competitive markets. I mean, we've been in one for the last 5 years. If you remember in 2020, those COVID years, the interest rates dropped to the 2s, the 3s, and everybody wanted to go buy houses. Why not? Yeah. Right? I did too. I was too busy working. I couldn't. But, and so when you have so many people rushing to buy, what does that do? Housing values rise. And the reason housing values are rising is because you're getting multiple offers. Right. People are outbidding each other. And then they're calling for highest and best. So after you've given your best offer and there's 10 others on the table, now they're calling for highest and best. So let's do it one more time. And a lot of these offers are cash. And so I think we were able to help quite a few people compete with those cash offers back then, and which is still going on today in many markets across Birmingham. One of the things that we always want to do is, first of all, let's have a discussion. Let's talk about the area that you're looking to buy in. Yeah. If it is a competitive market, or if the property you're looking for is competitive. And most of the time, let's be honest, it is, because everybody wants to live in the competitive areas. That's why they're competitive. Right. And so what we've done is I guess we did this 5 years ago, is we said, let's do what we call a TBD approval, which is property to be determined. And why don't you talk a little bit about that, since that's what you do a lot of.
Definitely. With a TBD approval, what we do is we collect pretty much everything that we're going to need for the loan process, aside from the appraisal. Okay. And then that allows us to go to underwriting, get a full approval. We'll write a special letter with their offer that says they've already been through underwriting. We can close in the time it takes to get an appraisal.
Many times not an appraisal waivers.
If you need an appraisal, in some of these markets, these competitive markets, you may not even need an appraisal.
Oh, okay.
The quickest we can close is 7 days by law.
Okay.
And we've done that before. We really have.
Wow, 7 days.
Yes.
A lot of 2 weeks, though. A lot of 2-week closings.
Okay.
A lot of them.
We had somebody that we did a TBD approval for. They put down a significant amount of earnest money based on the fact that we had already been to underwriting, and
they felt comfortable.
They felt comfortable doing
that.
Well,
and I'm not advising anyone to do this, but part of that contract is a lot of times you have that financing contingency, and if with a full underwriting approval up front, if you feel comfortable with removing that financing contingency, that makes your offer a lot more attractive to the seller. Okay. I mean, if you've got a seller who's entertaining multiple offers, but your offer, unlike the others that say we've been pre-qualified or pre-approved, if you have a full underwriting approval and you can close in less than 2 weeks, and you feel comfortable enough to waive that financing contingency, to me, that is almost as good as cash, because if you've got a pile of cash sitting here, unless it's in your checking account, you still have to liquidate it. Right. You have to go sell off the investment. Right. And there's tax implications of that, and we're not going to get into all that. But, the bottom line is that's not overnight. And so, that's just some of the things that we've been able to do that's allowed us to stay relevant in a cash market at times.
I love that. I love that there's multiple options that people may not even really know about. So I think a lot of people talk about second mortgages. I have heard that phrase. I'll be honest, I'm not totally sure what it means. I feel like I sort of know what it means, but can you talk a little bit about when something like that, or even just any sort of unconventional loan, might be a good option for someone?
Well, we've utilized a lot of home equity lines and second mortgages in the last few years, where people haven't been able to have the ability to sell their house first before they buy a new house, because it's so competitive. And so if you come into a transaction with a contingency that you need to sell your house first, in many cases, your offer's off the table. Right. And so what we've been able to do is, qualify with both homes, utilizing bridge loans, but more so, second mortgages or home equity lines of credit. They're cheaper to obtain. You're able to take the equity out of the house that you own and transfer it to the next house.
Okay.
And it's a quick and easy way to access cash. A lot of times, it's not the qualification. People will qualify with this house and the next house. A lot of the times, the problem is they don't have the down payment for the next house on hand.
Right.
Because
they haven't sold the first house.
They haven't sold the first house.
Right.
And, if you don't want to sell off your investments because you don't want to run into tax implications and stuff like that, quickly put on a second mortgage or a HELOC on the current house that you're in, pull out enough equity, just enough to put down on the new house.
Yeah.
And we can kind of go from there.
And then once you do sell the first house, you can pay off what you pulled out, and
and this is something we can touch on too. I mean, not only can you do that, but you can actually, if you clear more than what you took out on that second mortgage, which you probably will, you can then take the remainder down, say 6 months after closing, put down on the principal, and then do the recast that I think we've mentioned.
Okay. Yeah. And describe what a recast is.
Yes. So the recast is a wonderful tool that I mean, we've done lots of them. And so a recast is when you bring additional principal to the table after closing, pay down on your loan, and then we re-amortize or recast the payments.
Okay.
And it's free.
Oh, that's great.
Yeah.
And also, I was going to ask you the difference between a HELOC and a second mortgage. Can you describe what's the difference between those two?
So a HELOC is a home equity line of credit.
Okay.
Usually the rate's tied to prime, the prime rate. It's adjustable. Usually has a 10-year draw period, 5 to 10-year draw period. The payments are interest only. So if you just make that minimum payment every month, you're not paying any principal back.
Okay.
That's the downside.
Okay.
Usually after that 5 or 10-year draw period, it will actually amortize over the remainder of the term, the next 10, 15, 20 years, whatever it is, and you will pay it off. But, it is tied to prime, so as the prime rate moves, that HELOC payment will also move.
Okay, so it's not a fixed rate loan.
No, one of the greatest. I recommend everyone to get a HELOC.
Okay.
To have a HELOC on your house, whether you use it or not,
just to have it there in case you need it.
It's a credit card attached to your home.
Yeah.
With a much lower rate.
Yeah.
It's quick access to cash.
Yeah.
And so I think that's great. A second mortgage is more like it's a fixed rate. So if you know that you need $50,000 or $100,000, there's a certain amount of money that you need. You don't want to use it like a credit line, but there's a certain amount of money that you need. You can do a fixed rate second, and which is a second mortgage, which usually has a fixed rate of interest, and it's fully amortized, whether it be over 10, 15, 20, 30 years.
Okay.
So it depends on the unique situation. But I think both of them are useful tools. I think the HELOC's probably more useful in more ways. A second mortgage is more like a certain thing that you want to do, and you want to pay it off in a certain amount of time.
It sounds like the HELOC is like, here's a resource for cash if you need it.
Yes.
But you haven't actually taken it out. You're
Quick
just
cash.
approved to take it out, right? And then a second mortgage is like, here's a lump sum of money that you now have, and now you have to pay it back. Is that correct?
Yeah, and so we do a lot of second mortgages. For instance, like if people want to consolidate debt. Okay. And so, credit card interest rates are high, 29, 30%, whatever they are, right?
Yeah.
So credit card interest rates are high. Sometimes people run into, things in life that no one plans,
right?
And you don't want to file bankruptcy.
Right.
So a lot of times if you have that equity in your house, you put a second mortgage on that, and, you're able to take a 7 or 8% rate, which is not perfect. It's not great. It's not 4 and 5%,
but it's less than
right?
a 19% credit card rate.
100%.
Yeah.
And so, we do mostly second mortgages like that for debt consolidation purposes.
Okay. So what if someone is looking at one or the two? How do you determine which is the best path for them?
We typically go over both options.
Okay.
These are your options, and these are your primary two options. And it's pretty obvious which one is the best fit.
Just based on their current situation.
Going back to the situation where you need a quick injection of cash, you take that HELOC off of the current house to buy the next house. Once that house sells, you pay it off. That's going to be your best option.
Right.
Because it's a quick, it's not a long term. I would never recommend somebody take out $50,000 or $100,000 on a HELOC for 20 years.
Oh, right.
Because we as people tend to just pay the minimum payment.
Right, and they're not making any progress.
So it's like, it's just really, really sad. 10 years from now, if you haven't made principal payments, you still owe the same amount as you did on day one.
Oh.
So,
that'd be
yeah,
terrible.
I think HELOCs are good for a quick turn.
Okay. Good information.
Yeah.
I know you guys have a lot of experience, right? You said combined like 30 years of experience on the team, which is amazing. So to me, that says if someone does come to you with kind of a tricky situation, whether it's they're trying to make an offer on a home that, like you were saying, has 11 or 12 offers on the table and some of them are cash, or, they can't sell their first home, but they really need to buy this second home for whatever reason. Can you kind of talk about, and maybe there's some stories in here that you want to tell, but can you kind of talk about how your experience helps them navigate these situations?
Well, Casey likes to put puzzles together.
Oh.
Absolutely.
And I think many times mortgage is a puzzle.
Yeah.
So.
We have to get creative lots of ways. We had someone a couple years ago who the buyer he didn't have income. His dad would co-sign, but his dad also didn't have any income, but they had a lot of money in the bank.
So most places would deny you at this point if there's no income on the table.
Yeah. But they just had some sort of stockpile of cash.
Yes, and conventional loan guidelines allow us to derive an income figure from that cash.
Okay.
You don't have to touch it. You don't have to liquidate it. You don't
Okay.
have to withdraw it. But based on the fact that you have, let's say, several million in the bank, we say, okay, if push comes to shove, you
Right.
have the money to cover the mortgage.
It doesn't have to be several million. It could be 500,000.
Yeah.
Okay. So it doesn't even have to be that out of reach. Not like I have 500,000 sitting somewhere. I'm not saying that, but it doesn't have to be $10 million in order to be approved for something like
Yeah,
this.
we can generate an income figure for qualification reasons based
As
off
if they're
assets,
making a certain amount per year.
based off the
Okay.
assets you have sitting, without actually using those assets.
Okay.
Yeah.
And that seems like something you probably learned along the way. Do you remember, I mean, you may not remember exactly when, but do you remember kind of when this came up for you?
Yeah, it wasn't in the beginning. I'll tell you.
Yeah.
That. In the beginning, we had no income, no job, no asset loans. I think they called those ninja loans. We can't do those anymore. It was easy to do loans back then. But I would just say, like, going back to never saying no. Like, is there an option for this?
Yeah.
And so what we were talking about is asset depletion, where we're not actually depleting the assets. That's just what it's called.
Okay.
And so, yeah, I mean, just I don't know. I mean, you were probably born knowing this, but
No. There are things that only come up like once every 5 years in mortgage.
Right.
So that's one of those things where I bet some loan officers don't even know that that's a possibility.
Because they've never had to do it.
Yeah.
So you learn a lot just because a tricky situation comes up, someone comes to you with something that you've not encountered before, and so you just say, okay, you gotta put the puzzle together. We gotta figure this out. What's your first stop when you have to figure something like that out?
Casey, come here. Because she really loves to do it. I mean, she's the expert.
So you just kind of present the situation, and then what do you do with that?
Well, I think we both work together because we'll be working through something and then I'll think, oh, we've exhausted everything. And then Adam, who's been doing this for almost
A long time, just a long time. Long time.
He will just pop something out and I'm like, you know what? I always one step ahead of me. I had not seen that
Hadn't thought
before.
about that. Yeah.
But it's really just teamwork and knowing the guidelines, because if you know what you're doing, then you can use them to your advantage. But if you don't know them, then you don't know how to make them work.
I could see that. Do you guys remember ever having a situation that you thought there genuinely is no solution to this, and then being surprised by something completely outrageous? I'm just curious if there's something that comes to mind.
Frequently.
She has a better memory than I do. But yes, I know this has happened. Been a lot of prayers in our office.
Oh, yeah.
For something to come through.
A lot of prayers in our office, and it always seems to work out.
Yeah. We had a lady the other day who, it was a conversation we were having along the way, that she was maybe not going to net enough on her current home. And then Adam came up with this idea. How about, now most people don't want private mortgage insurance, but he was like, how about we do lender paid private mortgage insurance, and then she doesn't have to bring that additional $3,000 to $5,000, and she doesn't have to pay private mortgage insurance.
And didn't increase her rate either.
Or her payment.
Whoa.
Yeah.
That is a good trick.
Yeah.
That's nice. Okay. So clearly it pays off to have these people on your side. I think we've determined that from this video alone, but also if you haven't watched all the other ones we've been doing, we're talking about everything from first-time home buying to what to do if, like in this video, if there's a cash offer on the table that you want to compete with. So lots of really great advice. This is the Adam Snabel Mortgage Team. If you need someone in your corner as you're just embarking on the journey of buying a home, these are the ones to call. So thank you all so much for being here, and we'll talk to you again soon.